back to this week's Manager's Thoughts. This is Kelly from Synergy Asset Management. Today is February 3rd, 2023, and we're super excited to bring you just a slew of economic news and big updates from this week in the markets. Alrighty, so this week was definitely an eventful one. I know I say that every week, but this week was actually kind of one of the most important weeks so far of 2023, and many analysts are saying that it's kind of the most important week looking forward as we project into 2023 and the new year of what the markets and inflation and interest rates are going to look like. Wednesday, we had the FOMC meeting, we had a rate hike, and then we also had a lot of the market reporting earnings this week, and so we also had the January jobs report on Friday. So again, really eventful. Many economists are saying this is kind of just going to guide what the outlook is for 2023, and so as of Thursday, February 2nd, though, for just this week's performance, this week ended with a really strong gain in the equity markets, and yields were down kind of alternatively to that. And so we saw a 4% gain in the S&P 500 this week, a hefty 7.1% gain in the NASDAQ Composite, a little bit more modest 1% gain in the Dow Jones Industrial Average, and then, like I said, yields were down 4.2% in the 10-year yield. So definitely an interesting week, lots of moves in the market, and it'll be interesting to see how the market continues to react. So the first biggest event of this week was the January-February FOMC meeting taking place on February 1st, Wednesday. And so Fed Chair Powell announced another Fed funds rate hike, this time of the slower 25 basis point rate hike, as opposed to December's 50-point rate hike. And so markets were definitely really excited as Powell's commentary was pretty confident in the Fed's ability to manage these interest rates versus inflation, kind of, maybe a little bit more hopeful than he has been in the past of a soft landing coming up. So kind of following the conference, the S&P was up as much as 1.2% on Wednesday to close, following this really exciting announcement that the Fed is slowing the rate hikes, and it was also expected, but Fed Chair Powell was also a little bit bullish on the overall U.S. economy. And so here you can see just how we've moved interest rates over the last 12 months or so from that first March rate hike to now where we're at a Fed funds range of 4.5 to 4.75. So you can see that the pace at which the Fed is hiking has definitely been moderating just, with these last lower rate hikes in the last few months. It'll be interesting to see, moving forward if the markets are going to price in another 25 basis point rate hike or 2 or 3, or we're not sure completely at this point. So definitely good, important news to keep track of. Similar to the Fed raising rates this week, we also saw the European Central Bank and the Bank of England hike rates as well this week, this time by about 50 basis points. And so both the EU as well as the UK are experiencing inflation above 9% on a year-over-year basis in the month of December. And so it is downtrending, but it's still the 9% inflation is way above where they want it. So like I said, Europe is just a bit late to raising rates and tampering down inflation. You can see that in the chart there that the US is that dark blue line, whereas the ECB and the UK Bank are the light blue and the pink lines. And so they're definitely a little bit behind us just in raising rates closer to the inflation rate, kind of under that Taylor rule principle. They're both a little bit behind us, but definitely a smart move on their bank's parts, just hiking rates by 50 basis points this week as they try to get control over higher inflation. The last really big piece of news just from this week was the Friday jobs report. And so Friday morning, we got the BLS's jobs data for the month of January, where we got the unemployment rate, we got average hourly earnings, and non-farm payroll. Those are kind of the big ones. And so here you can see in the chart that right now we are in a really historically low unemployment era. So we've had below 4% unemployment for quite a bit of months. And so January, to kind of a big surprise, came in even lower from December's 3.5% unemployment rate, and it came in at 3.4% for the month of January. So very low unemployment we're seeing. You can see just through these business cycles in the chart there. Again, this is really low, and it's actually the lowest since May of 1969. So a very long time, over 50 years ago, since we've seen this really low unemployment, and it was also a lot lower than the expectations of about 3.6% unemployment. So it'll be interesting to see how the market reacts to this, but I'll continue in the next slide into a few more parts of this jobs report. So on top of that, we got the average hourly earnings growth. So that came in a little bit low at a positive 0.3% growth from December to January compared to estimates of about 0.5% growth, and so this is a good sign that wage inflation is slowing, which is something the Fed is definitely concerned about. And then kind of on an annual basis, this wage growth was about 4.4%, and so this was actually the lightest wage growth since August of 2021, which is, kind of a big deal that we're finally getting this wage growth and, this overly tight market to kind of start tampering down a little bit. And so even more importantly, though, kind of the biggest shocker of the jobs report was that in January we added over 500,000 jobs. And so estimates were closer to just under 200,000, over 500,000 jobs. It blew the estimates out of the park by 160%. And so just a huge beat on what the economists were really thinking. And just a reminder that, even when you think you know what's going on, you probably don't sometimes. So altogether, though, this jobs report, overall, we would say it's a good sign for the U.S. economy in achieving this softer landing, given that we just haven't seen the lagging impact of the rate hikes quite as much, at least in the employment sector, as opposed to, manufacturing is contracting a little bit more. But overall, employment is still very strong despite the higher interest rates. And so here you can see that, just comparatively, we added about 517,000 jobs in the month of January. And so that's just really high number, and it's more than double the pre-pandemic average. As always, here at Synergy, we're constantly watching the news. Even though I didn't report too much on the earnings reports this week, we were definitely hands-on with that, watching all of that get released this week. We're always watching Fed moves, we're watching, world interest rate moves, economic data kind of as it pours in, and, using that data to better maneuver each of our portfolios per their mandate. And so we're really confident in our ability to keep watch of the markets and manage accordingly. Thank you very much for tuning into this week's Manager's Thoughts, and we are super excited to provide another update for you guys soon.